Hello and welcome back to the 30th episode of the Capital Spotlight podcast. Your host here, Craig McGrother, the Director of Business Development, alongside the man, the myth, the legend, two-time author, founder and principal of Lone Star Capital, Rob Beardsley. How are you today, sir?
I'm good. I'm back in the office after, as you know, being a little sick and on our Texas trip. And so pardon the scruff on the beard, but it is what it is. As you and I like to joke, when you are clean shaven, that's when you're the most trustworthy. That's why every president in US history has been clean shaven. And so yeah, today I'm a little less trustworthy looking today.
Exactly. Well, speaking of which, let's get into the agenda. We're gonna do a little housekeeping, so we'll get into that. The Texas trip recap, Aspire update as it's a 506C, so we can happily and safely talk about that opportunity here today. Diversification is not how you make money; it's how you avoid losing it. Standalone deals or packs, and then books and resources listed. That was a question and inquiry one of our listeners had, so we'll get into that. On to housekeeping. Quick update. I will be in IMN Laguna Beach next week. So if you're going to be there at the montage, say hello with me. Would love to meet with you. If you were in fact there, this episode should be airing Monday. So quick little turnaround, but would love to connect with you if you're there. Additionally, Rob and myself will be at NMHC in San Diego coming up here at the end of the month. So if you're going to be at NMHC and you want to connect, let us know. We'd love to set a meeting with you. Additionally, we're going to be doing a event on February 1st in Newport Beach. So if you are looking to learn more about Lone Star Capital, want to meet us in person, I believe we're having an event at Lido House, if I'm not mistaken. I'm going to have to go through that as Dasha and I will also be spearheading more of the details with regards to that event here coming up this weekend. So no rest for the wicked here. When we do these Texas trips and whatnot, there's a lot of work that gets delayed. So I've got about 50 emails I got to get back to as there's so much we're raising for and working on right now. It's been back-to-back meetings as I didn't have a single meeting this week due to everything being in person. But I think those are the housekeeping items right now. Do you have anything else to note, Rob, in regards to housekeeping?
We might have to do like the all-in podcast and beep out uh the location of the Newport event. We don't want random people showing up, right? All of our many fans, right? We have a strict guest list, but reach out to Craig if you want to make it onto the guest list.
Yeah, I guess it's an undisclosed location. So we'll take care of that. But yeah, well, going into the Texas trip recap, definitely not how we drew it up, but it was very impactful nonetheless. Would you want to get into the succession and share some of the details? Well, I'll let you lead away there.
Yeah, so the trip started with us flying in on last Sunday night in anticipation of being at our newest acquisition, which we won't name yet, but we'll perhaps be able to talk about it later. But we have a new deal in Houston. We uh, flew in Sunday night to be on site filming on that Monday morning. We, of course, met at the Houston airport. We went to the United Lounge and enjoyed some very good barbecue at the lounge there. So we might have eaten a bit too much, but we were no worse for wear. And then so the trip started out great, honestly. Good food, get a good night's sleep. We got up and actually worked out at the
On Monday.
hotel on Monday
Yeah.
morning before getting dressed up and going to work, right? Which is something I'm super grateful for, and I'm glad that we're pushing each other on that because on trips, historically speaking, I've allowed myself to not work out, and I've justified it by saying, well, I'm on a trip. I've got a condensed timeline. I'm better off not working out. But I think those days are over, and I think it is just a better route to try to keep as much of my daily routine intact. And certainly working out is a critical component. And while at home, you might be able to get away with working out after work at night, while traveling, that's impossible.
Well, I'll actually will say that I really struggle, frankly, the older I get with my energy levels and the back end of the day. I like to run for 40 minutes a day. It's kind of just my thing. I get about 4.5 miles in, depending upon how ambitious I am and how much energy I do have, in fact. But I've found that if I work out in the morning, whether it be running around my neighborhood or going to the indoor track at the gym I go to when it's colder this time of year, I definitely feel a big advantage to my day. And yeah, I didn't work out any days other than Monday. And I was kind of feeling anxious and kind of just snippy. And I realized that was due to probably me not working out, unfortunately. So definitely solved for that this morning. I ran, but to your point, it's so crucial to bake that into your equation on these Texas trips and work trips because we're eating a little bit heavier as we're on the Texas side there, entertaining brokers, clients, LPs, you name it. We're doing it. So it's making sure that we get the movement in is crucial to start the day. And I just think, generally speaking, it's a lot easier to make an excuse at the end of the day. And, you can't get the day get away from you. You could get a task, you get a call that really takes your attention, that drains you from your day, or things could just go longer. But if you bake into your day that you're going to work out first thing, that's important. I like to wake up at 6:40 every morning here and get a run in, get some push-ups in, get the blood flowing. And I do think it has a very positive impact to my day to day by doing that and doing it first thing in the day. So that's how I like to structure the day. To start is obviously working out, but we got to work out Monday. We go straight to our newest acquisition in Houston, which we're very ahead of the schedule, seemingly, as we're working at the PSA there. But we're there. We had our incredible exclusive team, Weston and Chris and Jack as well. Jack wasn't there, so he unfortunately was the third member wasn't there, but we went over with our film team, did some filming regarding the property to show a little kind of introduction to it, to really display the opportunity there. Seeing is believing, especially in this era. The weather was a little bit whippy, so they had to come back the next day because it was raining and such. And then where else did they go from there? I think we smoked some cigars and watched the national championship. Is that right?
Well, we had a couple tours. We looked at some of our existing portfolio, and yeah, then
I
we
think
ended the.
that was the second day.
Oh yeah, you're right. Actually, yeah.
We were on site all day. Yeah.
Yeah, we were on set all day. That's right. That's right. It got blurry for me because to cut the story short, I got very sick, and unfortunately, that's where things just started going downhill quickly because I got sick, and then we took some of our investors out to lunch. We come back to the rental car after lunch. The car has been smashed into, and we had all of our possessions at that point in the car. So I would say on the bright side, only your backpack was stolen. So that was a fun adventure.
I will say this with zero sarcasm whatsoever. They took the best thing possible to take. If you took all my clothing, that would be unfortunate. I'd be smelly in the same suit. That would be very unfortunate. If they took Rob's stuff, that would also suck. Your backpack, your briefcase, we wouldn't want that. You had some other items that were remain nameless. That would have been a larger problem if that was confiscated. My backpack was taken, however. Inside of that backpack was my computer. So I have a brand new computer now, which of course Apple Care, for the record, does not cover theft. Phones do, so have that policy there. Never had my anything broken into before with regards to a car, and I'm from the Bay Area. So if you know being from the Bay Area, that's actually probably surprising, as San Francisco is the smash grab capital of probably the world. But inside of my backpack was my nice leather bound Ralph Lauren backpack. That's gone, but that was expendable for many reasons. But were also my supplements in there and also my toiletries. So I had to resupply my toothbrush, my razor, all that stuff. I'm still getting that resorted out. My supplements, that's a bummer, but the show goes on. And as I said, in all sincerity, that's the best thing they could have taken. So
So what you're saying is you haven't brushed your teeth in a few days?
exactly, I got really yellow teeth there. No, unfortunately, I probably went a little bit longer than I'd like to with that of flossing and such, and was not washing my hair because I had no product. And my hair, this is I don't wake up with my hair like this, unfortunately. So that was a fun experience. But nonetheless, we went from there. We unfortunately had to rain check dinner with our partners that we had set up later with the day. We also were going to have a podcast, a very special podcast guest that day as well. That was probably going to be airing this week for this show. That got canceled, unfortunately. So we ended up having to swap the rental car out in Houston, going to the Hertz Center at the airport, filing a police report, going to the Apple store, sorting that out. And then we drove over to San Antonio. A very fun 3-hour road trip where Rob used his incredible IT brain, the most underpaid IT person in America, to resort my computer up and to download all the programs necessary to not miss a beat.
I would say we handled the challenges that came our way pretty well, in spite illness, in spite robbery. So, yeah, it wasn't the trip that we were hoping for, but still productive nonetheless. It was good to connect with our investors that came out to visit the property, to meet with us, to go to lunch, go to dinner. So, always an exciting time to do that. And the more times that we're in the flesh, in the market, meeting with investors, the better. So, yeah,
Yeah.
definitely won't be the
Well,
last trip.
yeah. And then so the next day you were not feeling well. I'm like, hey man, let me just take care of this. Stay in the hotel, do what you need to do. And then I think I saw our newest acquisition, Aspire in San Antonio, with some of our capital partners there. And I was like, hey, you should just get out of here. And I think on that call, you probably just packed up and like, yeah, let me catch the 1 p.m. flight. So you did in fact do that. Then actually got to tour around some properties, and I definitely had a very interesting experience while in San Antonio, kind of seeing what's going on. So our newest property is on Bandera Road there, which gets about 25,000 cars per day. So our occupancy is not struggling. But the two properties that I also toured and saw were not really on the marquee locations with regards to a lot of foot and car traffic. And their occupancy right now is really struggling, which I found to be interesting. One deal was at 83%. And one of them, I heard it, but maybe I was tired. I was on the trip. It was this, it was that. I thought for some reason they said 86%, but actually they said 68% occupied, which would take a certain sort of lending profile to even accommodate an acquisition of that, if the loan is not assumable there. So that was kind of an interesting experience that we had dealt with on that little trip. But all in all, that was my first time in San Antonio. I really liked what I saw. It's a very nice city, had some of the best Mexican food in my life. So that was awesome. And our partners really enjoyed the experience, not only in Houston, but in San Antonio that came out. So it's always really fun to do deals and then also go on site and meet with our partners. We get to work with so many people that are just really special and talented and fun to be around. So I feel very grateful for the cast who we've partnered with and whatnot. So that was just incredible.
Yeah, no, really good stuff. And San Antonio is a fantastic market. And I'm really glad that you're able to spend some time getting to know the market and getting more comfortable, familiar and everything and understanding. I think the cool part about San Antonio, and not to diminish it in any way, it's a simple market. It's not that complex. A lot of people like to claim that whatever market they're in is it's very block by block. You never know. You might go one wrong street and you're in the wrong neighborhood and all that stuff. I mean, I don't think that that's really true in San Antonio. I feel like you've got your go zones, your no go zones, and there's a lot of good go zones for us at least. And we like the workforce housing. I think there's a lot of good product there. Uh, yeah, so I think it's a great place to be. But to your point, I think there are some occupancy struggles there. So, but that's going to be we're going to see that across many markets. I think over the next year and a half or so as things are softening in the market, but you never know what's going on in the economy these days, given the fact that the CPI data came in a bit higher than expected. Rates are still low. Who knows whether we're going to have a soft landing, hard landing, whatever it is. It's just kind of that's the thing about the market and economy. You just never know what's going to come.
No, you don't. And very interesting, as you mentioned, with occupancy and whatnot, the issues, and just generally speaking, with regards to how San Antonio feels and flows. If you're in Houston, there's so many amazing pockets, but all these amazing pockets are also surrounded by not desirable pockets. Where if you go a couple of minutes in the wrong area, you can kind of feel it. As I drove to the wrong hotel right when we got into Houston, which was not the greatest neighborhood. And that you very kindly pointed out to me after the fact. So that was kind of funny to go through and experience. But that's kind of what you can get in Houston, as well as just kind of random miscellaneous spread out development and whatnot. You've got industrial places next to manufacturing, next to multifamily. But San Antonio, it's very much so more distinguished, I would say, and descriptive as to where things are. That's kind of the saying in Houston: you can build anything anywhere with the zoning regulations and whatnot, or lack thereof, with regards to development. But San Antonio, you kind of know the areas are nice, and we all know that there's certain pockets that it'll be very clear and specified prior to being there that you may or may not want to go there beforehand. But overall, San Antonio felt very nice and safe. The tenant profile there is pretty awesome. Everyone there is very polite and respectful from everyone we interacted with. So I'm very excited. It actually exceeded my expectations in regards to what I was anticipating in that market. So that is always a pleasant surprise.
Yeah, definitely looking forward to getting back down there in good health, and hopefully we'll have a great group of investors again to join us. That's always a good thing. So the other thing, I was having a conversation with one of our investors today who knows the San Antonio market well. we were talking about different pockets, and it's just the classic catch 22 as we talked about it, where if you're in the hot spot, like let's say medical center, for example, that's a great pocket. But guess what? There's going to be competition. There's going to be new supply. And not only is there going to be new supply, you're probably also going to pay a higher price as well. So, do you want to be in the hottest pocket, but then battle new supply and pay a higher price? Or do you want to be in a place that's a little bit up and coming or just not as hot, but hopefully you're paying a lower price and you're not competing with as much new supply? So, where it's hot, there's new supply, and where it's not, there isn't, right? So, it's a rare circumstance where you're able to get a great price, not have any new supply, and you're in the hottest growth market, right? It's hard. It's the world's not that easy, right? You got to
Yeah,
pick your poison.
yeah, you're not just going to buy a deal in Dallas in the best location that's a 2000s vintage with a positive leverage cap rate at a discount. That just doesn't exist, not in the space that we're playing in. So that's the blessing and the curse is how stable it is, right? But it is a double-edged sword, and we have to be realistic on these times in these times. And with that said, we're in a very interesting buying window, which we'll get into here coming up. But that said, getting on to Aspire, we do feel as if this actually truly is a no-brainer. And there is just a little bit of space left. If you're an investor looking to learn more about this deal, you can reach out to myself. My email, but once more, it's craig@lscre.com. Should you want to learn more information about that, would you like to add any other notes about Aspire just regarding that? I mean, the race is going very well on our end, which is exciting. But any maybe other notes that you have, any other comments you've heard from some of our partners?
Yeah, the feedback's great, and you saw the deal just a couple days ago. For what it is, I mean, obviously it's not the most beautiful deal in the world, but for an 80s asset, I think it is well located on Bandera Road, like you said, and has great potential. We are, while it is our first deal in San Antonio, which definitely poses a risk, or at least short-term risk of the learning curve of getting ourselves established in a new market, I think that we will do very well with it because there's just so much meat on the bone. The current ownership is neglecting a lot from an operations standpoint. And so by hiring and training the right team for the site and just putting the care and attention that the property deserves from both an operations and a CapEx standpoint, will really sort itself out. The deal will be a well-performing deal in no time, which is exactly the type of opportunity that we want, so long as we're getting a discount for it. And I think in this situation, we absolutely are getting in at a great basis, considering the location, the fundamentals, the lack of new supply, and then, of course, our property tax exemption that we're putting in place on the property. And obviously, we know that that is perhaps a bit of a contentious topic, so we won't go into detail on the tax exemption there, but that is a product of Kent's magic, as always.
Yeah, and it's really nice to have a deal profile that has a defensive strategy in this market coming up, where we're really not fully reliant upon getting a $200 to $300 rent pop right away after renovations of units to achieve our business plan. I'm definitely concerned about getting rent pops here coming up. I don't know if there'll be much rent growth of anything next year, but the great news is that we have very conservative inputs with regards to the underwriting on this one. That makes me feel very good. We're actually on average bringing rents down a dollar, going from 941 to 940, while putting about just over $6,000 per unit into the deal, which is great. We're achieving a very, very healthy 8.3% cash on cash return on this deal with only 2 years of interest only. So, amortizing after those first 2 years, really a lot to like there. And the deal makes sense actually as well. I know what are you thinking? Oh, well, what if the tax payment doesn't work great, or you're only buying it because of that? No, we would probably buy this deal regardless of the tax payment or not, which is definitely what we look for. We want to find good deals that we would like regardless, but then inject it with a little bit of a steroid, give it a little bit of a tax abatement, and watch it cook. And that's kind of what's going on with this opportunity. So we're really thrilled about this one. The raise is speaking for itself. It's going very well. As you mentioned, it's about a $9 million equity check, and Things are looking great there. There's a bit of space left. So as I said, the remaining spots will fill up quickly. So let me know if I can be of a service to you and answer any questions on this one or every other deal or any other deal, excuse me, or kind of what our strategy is here coming up. But a nice defensive strategy in this environment is what we're looking for. It's hard to lose money in real estate if you have a conservative debt profile, a good basis, and a modest business plan while still putting some value add in there.
Yeah, absolutely. Yeah, no, just recapping the deal makes me more excited about it and looking forward to getting it closed in about a month or so.
Yeah, and I was a little bit skeptical on this one too, frankly. I think I alluded to that to you. Not saying I was, oh, this deal is not good or this, that. I just didn't really understand it, but being there really did make me feel more comfortable. You mentioned this, but for an 80s deal, I always look at, okay, well, what's the deferred maintenance like? What is the dry rot like? Is the exterior looking good? And I will say I'm very impressed. There wasn't, shoddy looking roofs, old gutters that were kind of hanging down or, paint chips everywhere. It was very nicely exteriorly maintained, which makes me feel very confident. The amenities too for an 80s property were very rich. There was a lot of amenities there to make us more competitive and give the tenants better experiences at the property. So I really look for things like that. And then kind of some of the unseen benefits. Shout out to Hunter Thompson, as he would say. It's all about practicality when you buy deals and you think about, well, what is the tennis experience going to be like? And the broker walked us through it. Cody, and he was saying, there's really good shopping areas with Walmarts and stuff nearby that, the tenants would actually tangibly go to and use for their needs. And then on top of that as well, there is a bus point right outside the property that will take you from any point to the property. So, we work in workforce housing, right? That's what we look to buy, excuse me. And, a lot of our tenants do in fact take the bus and rely upon public transportation as their means to get from point A to point B around the city. So to have a bus like that could take you anywhere you need to go is just really important. These are some things that I don't think a lot of people think about, but logistically speaking, this property checks all those boxes. And it's not a mystery as to why this property over the last 27 years has been maintained occupancy at around 92, 93%. So as I was at the property, it really made sense as to why that is. And it makes me feel comfortable to know that, hey, past success is, can be an indicator, cannot be, but I do feel like it's going to be an indicator moving forward of, maintaining good occupancy as, as you said, coming up here, just generally speaking, with a lot of supply coming online on many markets, historical occupancy, supply coming up, those metrics are really key to me. So excited about that. So there's your Aspire talk and Aspire deal update. On to the next topic, which I think is very interesting, is the buying window that we're in right now and how long it may or may not last. So I kind of have a theory on this one. So I think a lot of people are baking in price or rate cuts coming in, right? So if rate cuts are coming, a lot of sellers, logically, if you are a seller, are probably going to try to wait until that first cut is made, right? So if that first cut is made earlier on, that buying window that's really, really sweet may not last as long because all these institutional groups may come into play to acquire some deals. So selfishly, do I kind of hope rates don't get cut anytime soon? The answer is kind of yes, because we could potentially have a longer window, not just a 6 to 9 month window here to acquire properties. Maybe it's a year long, right? Obviously, you can always find a good deal in any market, depending upon the basis you get it at. But my kind of theory is that there's not a lot of deal flow right now. And the thought on that is because there's not a lot of deal flow because people are waiting to try to get at least a rate cut in there before they're marketing the deal. I would love to know your thoughts and perspective on the matter, of course.
Yeah, like we've been saying for a long time now, people generally aren't selling right now unless they have to. And so there's not a lot of have to in the market. And the longer we wait, the more have to we'll see. And by that, I mean, sellers don't have forever that they can just wait at these interest rates. We're at very high interest rates. Specifically, I'm talking about the short end of the curve, which is directly controlled by the Fed. So as the Fed moves rates, SOFR adjusts, and SOFR is what the vast majority of floating rate bridge loans are based on. So if a current owner is sitting on a floating rate loan, it's most likely indexed on SOFR, and SOFR is very high right now at 5.3%. And so that is a problem for many owners, but it doesn't become a problem overnight, right? It's month over month over month of having to eat these higher debt payments where eventually the seller or the owner becomes incapable of servicing that debt or no longer wants to and doesn't want to have to make a capital call and would just rather sell the deal. And so that's what the market is kind of waiting on. And to your point, a lot of people are sitting on the sidelines waiting for this big moment to jump in for all these amazing deals. But the problem is, if all this capital is waiting to jump in, the second that there's any opportunity, all this capital is just going to compete against each other to jump in. And so if everyone's sitting around waiting for a big opportunity, it's not going to happen. And so that concerns me because I want there to be a big opportunity. But
Yeah, we're nicely positioned right now. We don't really have any distress in our portfolio. So we want to play offense and get aggressive. And we want there not to be, blood in the streets. We want there to be, corpses and bombings and whatnot. We want it to be, decimated, frankly, but it may not happen.
it may not happen. And so
At least in multifamily. Obviously, office is its own set of issues. We're only hyper focused when we say that in reference to multifamily, what our niche is, right? Single family, very secure right now. But office, industrial, can't really speak to them. I know office, the headlines are probably real. But this window, it's we'll see.
yeah, I was talking to a group of people a week ago, and someone brought up the fact that a month or so ago I had said that I thought the bottom was 12 to 18 months away, and what did I think about that comment now, right? And obviously, I don't know the future, but that's never stopped me before, so I'm always making predictions, and I kind of got nervous about that prediction because I felt that our bottom is going to happen sooner. And so, and a bottom is not a bottom. That's a silly way to say what I'm trying to say, which is that there's more than one bottom. You can have different definitions for a bottom. You could say, okay, the bottom is the bottom in pricing. You could have the bottom to mean the peak in cap rates, which are two different things, by the way, because you can have NOI change, right? So
Can you break down that thought a little bit more, please?
yes.
That's really
So
interesting.
yeah. So obviously, when you get into commercial real estate, you learn the magic calculations and relationships between cap rate, NOI, and value. And obviously, as cap rate goes down, value goes up. And as cap rate goes up, value goes down. Well, obviously, the other missing part of the equation is NOI, and NOI also goes up and goes down in time as well. And so, what we could have happen right now, what we've seen right now, just to kind of make this example more understandable, is we've seen NOI, I would say, probably if you're lucky, be flat. It's maybe down because of how much expenses have gone up. So in our portfolio, we're seeing rents still go up, which we're lucky to see that because it's kind of 50-50. A lot of markets are seeing rents go down even across the country. So we're lucky to be in Texas. We're lucky to see rents still going up a little bit, but our expenses have gone up a lot. So our NOIs are mostly flat. So in that situation, let's say NOIs have been flat, but cap rates have been expanding. So what does that mean? That means prices have been coming down. Well, cap rates could now stay the same. Like we could have flat cap rates now, but prices could keep going down even more if NOI goes down, right? That's the other piece of the equation. And that is a product of a recession, which is something that we haven't experienced. We avoided a recession in 2023, and the Fed has been engineering a soft landing. So they are purposely, their stated goal is a soft landing, which means they want to have a recession. So I don't know if they actually are quite wanting that now, if they look at the numbers or whatnot. I know everyone likes to kind of talk crap about the Fed, and everyone is smarter than the Fed somehow. But it is from the outside looking in frustrating to see the Fed kind of their rhetoric and their actions and whatnot. But I digress. So yeah, the point about that is we may have seen a peak in cap rates, right? We've seen some big moves higher in cap rates, but that doesn't necessarily mean prices are done going down because if we do see a recession that is predicted to happen in 2024, we're likely to see NOI come down. And if NOI comes down, it's going to make prices come down. But that doesn't necessarily mean cap rates are going to move. They might, but it doesn't mean they will. So we could see cap rates stay steady, but prices continue to come down, which that doesn't necessarily make it a better buying opportunity, right? Just because, I mean, yes it is. Obviously, buying at a lower basis is better than buying at a higher one. But if the cap rate's the same, it's not like this huge difference. So all these things really matter. And then to add in another variable, which complicates things, is all of these variables, specifically, most importantly, the cap rate, is heavily correlated and very value dependent on interest rates, right? If I told you, oh, I just bought this deal at a five cap, well, guess what? That was great when rates were three, but when today rates are almost six, a five cap's no good. So cap rate really has meaning when it's uh, weighed against the interest rate environment. And so the bottom might be represented by the bottom in pricing. It might be represented by the peak in cap rates, or it might also be represented by the peak in spread between cap rates and interest rates. To me, that's a really, really great one because that reflects probably the best buying opportunity in the most simplistic way. Obviously, we look at all these different metrics and we need to look at things holistically, but if you just look simply at that spread, that's a really telling sign of a good buy. If you can get in at a great spread, I know, shout out to Jeremy Roll talking about his famous 150 basis points of spread that he's looking for. So to put that into perspective, if you're buying a deal at a 6.5 cap, which is a great buy today, Jeremy would need an interest rate of 5% on the debt for it to pass his 150 bips test.
I'm salivating at the mouth for those opportunities. And I just don't know if we're ever going to get that 150 point spread that's needed to hit the rollonomics in the markets that we're playing in or in growth markets. So, it's a really healthy sign there. If we could get there, I mean, it would be a dislocated market, as you always allude to. You like that phrase, the dislocation of it. I would love for that to occur. But, a couple of things. You mentioned that you can't tell the future. So I was just wondering if you could comment on the fact that your Patek Philippe's, so they don't tell the future, they just tell time.
Yes, that's correct,
Okay,
unfortunately. But
gotcha.
they're
I
they're
just
still
wanted to
worth the money.
right. Okay, gotcha. I was just want to clarify that or not as a Patek Philippe expert, as you and Igor are, of course. So just had that in my mind. Wanted to make sure that was there. What would be the metric though of all those items you just mentioned that you would like the most, that you would like to hit on the most, that fundamentally speaking, you would like to see to make you feel really confident about, the 2024 and 2025 acquisitions?
Well, first, let me tell you what I don't like. And this is something that I have observed in people doing deals, people that I respect greatly. But and when I say I don't like this, I'm gonna kind of poke holes in it, but I'm also going to accept it as a good argument or as fact. So I'm not denying it or saying it's wrong. I just don't really like it. And there's this argument that has taken hold, particularly by people who are buying Class A product. Um, I would say this argument is even the strongest argument for new development. So if you're buying new construction from the developer, they just built it, and you're going to take on some lease up risk. I think that's a fantastic strategy. It's just complicated, and I'd love to break it down a bit. But the argument that people make is, and even more specifically, a justification that they make for buying at a low cap rate is that they're arguing the fact that cap rates are low, therefore there's not going to be new construction. And so they say that since there's not going to be new construction, rents are going to grow. There's going to be rent growth. So yes, we're buying at a low cap, but because prices are low, so again, we talked about um, the relationship between cap rate and value being that, well, when cap rates are higher, that means values are lower. And then the opposite is true. But however, we're in a funky situation right now where if you're buying Class A real estate, Class A multifamily, you're buying a kind of a low cap in my opinion, but it's the price is low. And I know that usually low cap would mean high price, but it's just not the prices come down a lot. And so it's come down so much to where it's not that appealing for a developer to build. If a developer knows that they can build a new product and sell it for, let's just say 200,000 per unit, but it costs them 180 to build, that's not a good development spread at all for them, and that's not going to entice developers to build new supply. So if you have
Yeah, that's
dynamics
that's
like
a
that,
that's a interest rate hike away from losing all your money in regards to offloading that property on the back end of your developers. But that would sound like with only a $20,000 spread per unit.
yeah, with one change order and 6 month delay and whatever, that's not a good place to be. So with those sorts of tight dynamics in the development space, you're going to see less development occur. This is the argument. You're going to see less development occur with the environment being this way, which means rent growth is going to spur to grow, right? Rents are going to grow because you're not going to have supply. And obviously, when you're talking about Class A product, new construction, those submarkets, those pockets are very affected by supply, right? You build a new high rise and then bang, all of a sudden you've got concessions and it really impacts it. So what these groups that are buying these new properties, they're buying 2020 or newer vintage deals at competitive prices, but they're justifying paying these high prices by saying, well, we think that there's not going to be development because of where, and I know it sounds weird because I'm saying high prices, but I'm saying they're low prices because developers can't make a profit. But that's just the environment that we're in. We're in a weird environment. And I just don't like the argument. It doesn't make a lot of sense to me. And I think it's a way for people to justify buying deals that are hard to justify. It's kind of like, well, the cap rate's not good, but my basis is good. So I don't like that argument. Basis argument's tough for me. If I'm saying, well, I'm buying at negative leverage, but I'm buying below replacement cost, like it makes sense on one hand, but I don't buy it. I don't like that.
Yeah, well, there's two kind of cities right now that make me think about, lower cap rates, and they're both experiencing different items right now, and they're both on the opposite coast. So you have think about San Francisco. San Francisco historically has had very compressed cap rates. They're finally expanding right now, but rent is retreating, caps are expanding, and talk about a city you really could hardly get any development done, and that is in fact San Francisco. And there's not the best growth trends right now. I think at some point the city will come back when we don't know, but that's kind of to your point where it's like, well, it's tough to justify that. New York, on the other hand, also has very, very compressed cap rates, but New York's New York. It is truly the best city in America, probably in the world, and it will be fine long term. It's maybe sputtering a little bit right now, but also a similar political orientation in San Francisco that makes it challenging, but also developing and bringing units online there is very challenging. So those are kind of the two thoughts that come to mind as well, if that has any correlation to what you're speaking on at the moment.
Yeah, I mean, I wasn't really thinking about those gateway markets because obviously that's not where we invest. But yeah, I mean, those are good examples, except for, I mean, I don't know the exact numbers, but New York definitely has a more robust supply pipeline than San Francisco. That's the thing, even though that New York is politically challenging and there's a lot of, it's hard to get things done for many reasons. It is a city that is pro construction, which there's a lot of it. It's a
Yeah,
big city, so it's hard to offset the existing stock with new supply. But all the new supply that comes to the market, which there's a decent bit of it, it just gets right absorbed.
absorbed. Right, right.
So anyway, that's what I don't like. But to take one good positive nugget out of that is the concept of buying from the developer and buying new property. I mean, we're seeing that flight to quality happen and we're participating in that flight to quality with some of these newer assets that we're pursuing and having the good fortune to pursue by the dislocation in the market, as I like to say, as you pointed out. So the reason why buying new construction is so attractive right now is is going back to the argument that I was kind of poking holes in is because you are potentially able in some cases to buy below replacement cost. So you are buying from a developer who just built something for, let's say, I don't know, I don't know this market that well, so I'm making up numbers, but let's say they just built it for 250 a door and now you're buying it for 220 a door. That right there instinctually is a nice buy. But the problem is the cap rates might not still be attractive. You might be buying negative leverage because that's just where we are in the market, and interest rates are potentially a bit high right now. Shout out to Peter Linneman, as a matter of fact, who guests on the Walker webcast, which is, I know people ask us, what other podcasts do you listen to? And
Which we'll
we,
get into that.
yeah, we spoiler, we tell people we love All In, but yeah, we'll get into that. But the other thing, I couldn't think of it in the moment, but the other podcast that I listened to, really just Peter Linneman's guesting, is the Walker webcast. So every quarter he's a guest. Peter Linneman is a real estate economist. And so anyway, the reason why I brought his name up is because his prediction, first of all, he got all his 2023 end of year predictions right, which was very impressive to recap on the show. But then he made his predictions for this coming year. And he said by the end of 2024, he thinks the 10-year is going to be around 3.4 to 3.5. And one,
So
Mhm,
yeah, and what spread do we trade off to? It's about 1 point something on that, right? For debt and whatnot. At that point, will that spread be different, or how do we factor that into our equation?
so lender spreads, if you want to be rough with it, are about 200 bips. Certainly, you can do cheaper depending on structure and location and all sorts of good stuff. But if you want to be conservative, just throw a 200 spread on it, and that would put you from 3.4 to 5.4% rate
Okay,
as
so
your
we're
all-in
saying
rate.
then, so we're saying if he thinks that, the what year treasury was he predicting it to
10
be
year.
at that number? So the 10-year there, what do you think? I guess, maybe the yield curve will be inverted or not. Where do you think the 5 and 7 year debt terms will be at then by year's end with that forecasting?
I don't recall if he made a commentary on the yield curve and the other uh, runs on the treasury, but just me personally, I think that we're going to see we need to work as an economy towards getting back to a positively sloping yield curve, right? That's what a healthy economy has, and we haven't had that for a long time, and we need to get back to it. But it's not going to happen overnight. So I think that we will, throughout 2024, get get back towards. We will think about this now. I think we'll probably remain inverted for the whole year, something like that. So yeah, I think we'll have a flat to negative yield curve. So basically, to answer your question, I think the 5 year and the 7 year treasury are going to be just somewhere closely aligned to the 10 year. I don't think there's going to be a big steepness where I know what you're getting at basically. If you borrow on a 5 year term instead of 10 year term, are you going to get some index rate savings? All right. And so right now there's about a 10 basis point difference, which is not nothing. But I don't think it's going to be much more than that.
So that we're talking about middle fives, tentatively speaking, to his forecasting, which he clearly had his crystal ball accurately working for 2023. So that means if we can get deals around that 6%, 5.5 to 6.5% cap rate, we'll have some nice positive leverage here for all of our 2023, 2024, and 2025 acquisitions potentially, which will be nice.
Yes, yes. And so the reason why I bring all that up is because basically Peter Linneman is projecting, if you are tracking the numbers, he's projecting roughly a 50 basis point decline in the 10 year. And he also thinks that there's going to be, I think he said 4 rate cuts this year, which I think is fairly consensus. So he's not being radical when he says that. So that brings SOFR down to, call it four-ish, 4.25.
Big to all those on the floaters.
Yeah, exactly. So that's some welcome relief. Hopefully it comes, or maybe hopefully not, depending on where you're sitting and what your goals are for the year. But yeah, just to finish my thought, I know I've kind of gone in many directions as I do. So
Rob, people love your tangents. Maybe not mine as much, but yours certainly.
I appreciate that. That's good to hear. Uh, so buying that new development is attractive. If you're buying it for 220 a door from the developer who's costs are 250, right? You're getting in at new construction, right? You're buying a new 2023 vintage deal and you're you have a moat against competition because if anyone wants to build around you and replacement cost is 250, nobody can do it without justifying higher rents. So that's locking you in for a good buy, pretty much. But right now, the financials don't support it because you might be buying that deal from the developer at a five cap or something. Even worse, you might be taking lease up risk. So you might be buying from the developer at 30%, 40%, 70% occupancy, and you're going to take that lease up risk to get that property to 95, which to be fair, I don't think lease up risk is a big deal. Thankfully, multifamily fundamentals are super strong. And I don't think they're going to soften to the point where lease up risk is a big deal, right? If you're buying in a quality market, that lease up risk is no big deal. However, where it plays a big role is on your financing because you can't go to Fannie and Freddie and say, give me a 10-year loan on this beautiful brand new deal if the deal is 50% occupied. So now you have to go to a bridge lender. And so now you're financing floating and short term on a asset that doesn't have value add on it. And so
And you got to
that's
be very scrappy to improve your occupancy. Likely gonna have to give up concessions galore to get it to a reasonable number so you can get a decent exit price.
all the meanwhile you're paying a high interest rate on your bridge. So it kind of the high interest rate on the bridge kind of wipes out some of the profit that you were potentially going to see from buying that development deal at a lower basis, below replacement cost. So there's no free lunch. Unfortunately, it's a tough world. If I had a mountain of money, I would probably be buying those deals, but I'd be buying them cash, right? So I would be buying the brand new deal at hopefully maybe like a low to mid five cap if I could find it. And then I would just sit around and wait. And, or, I'm probably, if I have a mountain of cash, I probably have Jamie Dimon as my banker and I can probably get some line of credit at a really cheap rate. So I'm kind of using my line of credit, sitting around waiting to when I can go to Fannie and Freddie with a good occupancy, with a good P&L to then and wait for treasuries to come down to 3.5 by the end of the year if Peter Linneman is correct. And then I can finance at a low five rate. And now I have positive leverage on my brand new deal that is below replacement costs. And there I can't lose. So I think there are smart people that are doing smart things, but all in all, that new construction segment is very tough to make sense of right now and to make some real good money. So yeah, that was like what 20 minutes to talk about what I don't like into kind of what I do like. But anyway, interesting stuff there. As far as what I do like of those three metrics that we talked about, price, cap rate, and spread, you got to go with spread, right? Spread is just so informative. It lets you know uh, really cash on cash and cash on cash, not cash, but cash on cash is king, right? And if we're able to buy on positive leverage like we are today, like the deals we're seeing today, it's really a no-brainer and it's a home run time to buy. And we're going to look back on 2024 and go, wow, I wish I had more opportunities like that.
So you mean by spread, you mean basically the capitalization rate being higher than the interest rate? That's the spread that you're referring to, correct?
Yes, that's the spread. And
Okay.
and and specifically the interest rate on your debt. And I know that's really semantic, but like you said, there's a lender spread. So if the 10 year is at 4%, like where it is today roughly, there's different lender spreads. And so if you're using a more expensive lender, they might have a higher lender spread of, let's say, 300 basis points. So it's a 7% rate. Or if you have unique relationships, or if you're getting discounts because of affordability or whatever it might be, you might actually only have a 150 basis point spread and your rate might be 5.5.
And I believe on Aspire, we have a 1.89% spread. Is that correct?
That sounds about right.
Yeah, 1.89 spread. So if you want to calculate tentatively the interest rate, I just saw the 5 year shot down a couple points today. So the rate would be around, I believe, 5.74 today, which would be really hot. So that would be awesome. So another shameless plug to our incredible acquisition there in San Antonio. Moving back to what you said, his predictions were, I think it's fascinating to reference someone who got all of his predictions right. Clearly a savant in the multifamily real estate space. Do you mind also just sharing some of his other predictions in reference to what he mentioned in that snippet? And also, if you wouldn't mind putting that in the show notes, would be great to have that there for those who are looking to deeply enrich themselves.
Sure. Yeah, we can link to the YouTube video for that for the Walker webcast. So yeah, his other predictions were I think he thinks oil is going to be somewhere around $68 a barrel, and
Is that high? Is that low? What does that mean
that is
for
that's
context?
that's normal. And that's certainly high enough. And also something that shocked me and is I had no idea, and I don't even know if I heard this right, is they said that America pumped more oil out of the ground in 23 than it has ever in history. Is that
Yeah,
true?
that would make sense because I know that they did reopen that, despite all the terrible headlines saying how Trump was just an awful person for the Keystone, this, that, and wanted to pump oil and fracking, how terrible it is. He got a bunch of flack for that. However, good old Joe Biden is doing that, but he never gets any grief because, of course, he's a Democrat, and if they pump oil, it's fine.
I mean,
Neither
hey,
here
if
nor
if
there.
if Joe is able to make us have energy independence, I'm all
Well,
for it.
I'm not trying to sound like a hater. I'm just, very neutrally speaking here. It's just annoying how one could do this, another could do that, and one side gets grief and the other side doesn't. It's obviously just clearly a news media outlet, and they can create their rage accordingly, which I just find interesting. Neither here nor there, but what is here and there actually really is tethered to Lone Star Capital because there are interests in the oil and gas market of Houston. It is very important where that is. That's why I asked, is that high or low in reference to cost per barrel. So, cost per barrel being neutral or solid is very good. And, obviously there's a lot of unrest in the Middle East currently, and we're very sensitive to that. Every side of the aisle, just generally speaking, it's tough, but potentially, items not being the best with Iran, of course. It does make me feel pretty bullish and optimistic for at least the near-term future with regards to Houston, being the petrol capital of America, to keep pumping there and drilling off there in the Gulf, whatnot. So that is actually a benefit to Houston, as it is kind of oil and gas sensitive.
Yes, there's a lot going on there, and every year when you talk, and so I mean, for those that aren't familiar with the oil and gas industry, and not that I'm an expert by any means, Houston is more downstream when it comes to its oil activities. So there, when you're talking about drilling, you're talking about West Texas or in Oklahoma, and so that's where you've got oil rigs and people are drilling, and the drilling can stop on a dime if oil goes too low. If oil drops to that, the number's always changing and the number's getting lower because as the technology improves, the companies get more efficient and they can be more profitable at a lower oil number, right? So if they can make money by drilling at, it used to be like $60, and now they can make money by drilling and selling when oil's $50. And now I think they can even do it at $40. So that's happening. It's much more volatile in West Texas. And so that is very, very oil sensitive. I mean, you know that when you're buying out there, you're buying basically an option on oil because you've got
It's like a
120%
future.
occupancy one day. And then if oil drops, it's like all those guys are leaving town. So
Yeah.
in Houston, it's definitely much more insulated than that. You have downstream activities, you have petrochemical stuff. And so it's not quite as, yes, exactly, plastic. So
Exactly. Everything that's manufactured, any plastic, any makeup, whatever it may be, to create things like this, anything, it all goes through petrochemicals. So that's
Yeah.
all basically in Houston. So just think about that there. That's one of the main amenities. And obviously, just like Phoenix is looking to diversify from being a boutique market with, hospitality and whatnot, they're looking to branch out for tech, call centers. Similarly, Houston is looking to diversify its employment base, and it's done a very nice job of doing that and has only continued to grow in that regard.
Yeah, I mean, Houston has for a long time established itself as the energy capital of the world, and it is pushing itself to reinvent itself as the energy capital 2.0 of the world, right? And we know that there's a big push for renewables and everything, and so that is taking hold. But with all that being said, oil's not going anywhere. The demand for oil is not going anywhere. And so, yeah, I feel very bullish on that. And for him to say $68, it's just kind of very neutral stance. So, I mean, to answer your question, that's not high or low. That's that means that the U.S. oil and gas industry can function normally at
Which is good.
$68, which
Normal
is
and
good.
stable is fine. Like I'm
Yeah.
all for that. It just going low or getting too hot is concerning, in my opinion, because
No,
too hot
totally.
means Houston pricing will get out of whack and dislocated in the other direction of it being maybe too hot and too speculating on that fundamental as opposed to actual numbers and whatnot. So that's just why I wanted to go in there. What were some of the other forecasts as well? Sorry to keep going through and to unpack that little segment that we're on right now with our crystal ball, the crystal ball segment of the day.
Yeah. So another interesting thing that resonated with me was his single family commentary. And so he talked about how single family is undersupplied by 3 million. So if I got his numbers right, I think he said there's about 100 million single family homes and we need 3 million more as a country. And the problem is after the GFC, the global financial crisis in 2008, there were structural changes and NIMBYism, which stands for not in my backyard. So you've got NIMBYism where development of single family has just not caught up to the pace to pre GFC pace. And so we are kind of secularly undersupplied on single family where we're just not building enough and we just every year we need more of it.
I have a lot of thoughts on that. And there's going to be a very large contingent of the single family population that will just effectively become ghost inventory, meaning it won't really trade. And that's due to a slew of reasons. One, a lot of houses are really paid off for inclators. So you'll sit on it, whether it just be, collecting the costs associated with the holding costs. If you're in some states, Texas is not one of these states, but if your property tax is pretty predictable and insurance costs are low, your hold costs are basically nil. Obviously, if you own in Texas or in Florida, those costs are crazy unless you homestead it somewhere in Florida where you kind of cap your insurance and property tax increases on an annual basis. That's not most people. So if that's what's going on, you're not really going to trade as much there, right? If you're in California, there's same thing called Prop 13, which will lock in your property taxes unless you change your basis a la a renovation, a remodel, or a transaction that basically sets it to current day. But generally speaking, you have that. So interest rates being sub 4%. Why would you refi? It's more expensive for you to move. You'll just turn your house into a rental. Of course, another elephant in the room is the folks like BlackRock and private equity groups who are buying homes in heaps. However, there are a ton of buzz of having conglomerates and groups like that not actually able to play and operate in the free market space of home sales. I can speak to you right now that I sold 10, 15 homes as the listing side to those conglomerates, and they're great to work with. They pay cash on a very compressed cap rate and make the process very easy with basically no asks to the repair process. And my former life and former career of the home sales. So all those things are going to bottleneck the single family home supply. And, considering that speaking, every recession looks a little bit different. Obviously, it was a mortgage crisis in the GFC, which created, mass foreclosures, which created price softening because there was a ton of supply and not a lot of demand. Now there is very, very middle to low end supply, not a lot of development, and rates where people aren't going to move. Therefore, the home market is propped up. In a lot of markets, it really hasn't gone down much at all. A lot of the hot markets where they have good population trends, Texas being one of them, Florida, Arizona, Tennessee. Those have been, the Carolinas have been big recipients of, stability and also appreciation in this last year, even with the rates getting as high as they did. So it doesn't surprise me at all. And there's been kind of a housing shortage. And the reason why is there was too much supply before, and no investor or no developer who's obviously an investor who wants to make money is gonna want to unload their houses and whatnot in a bad market where they can't make their spread, right? So the shortage supply there is definitely people who have the fear of getting their hand bit again by a crazy market change. So, similarly, we're going to see coming up here is no one's going to be developing multifamily, but single family that will likely occur. And it's funny, when we did drive from Houston to San Antonio, I don't know if you noticed this, but my brain always goes here was all the home developments kind of in that Katy area, which is a growing and emerging area. It's going to be more secondary and tertiary places that are going to be in receipt of these home developments naturally, because what? Because the prime areas are already built out. So it's just going to be more sprawl out there in kind of those high growth states and markets like a Texas, Arizona has a lot of communities being built. Tennessee, can't speak to it as that much, but I know there are some housing developments, whether it be Hayden Homes and Toll Brothers and whatever you name it, whatever D.R. Horton, the big Dr. Horton, if you know, you know. So a lot of that going on there, which is exciting. But there's my home tangent. So I don't see that to go down. I actually think you're really screwed, because if pricing is the same today, but your interest rate has doubled or tripled, do the math on what the payment looks like. It's pretty tough. So inflation's really hitting people, and that's some place where it is. So I will always recommend anyone fix your cost if you can. Afford it and it makes sense to acquire a house, depending upon the state you're in. I do think it's a great hedge to get your costs more fixed. But obviously, if you're in a state with more variability, with property taxes going up on you and insurance costs, it's tough. I know New York, it actually gets reassessed every single year. States where there's more reassessment and kind of mark to market there creates more transaction flow and volume and
For sure.
velocity.
So the one piece you mentioned there is affordability, and how, yes, prices have gone up or down, but interest rates have for sure gone up. And in the end, it has manifested in a dramatically higher cost of ownership for single family,
Which is
and
great for who?
which is great for multifamily. Exactly. And so that's the discussion here. That's the notion, is that with single family being where it's at, and with no signs of it, I don't see us having a big recession or a big drop in single family prices. So if people are waiting around to buy a home or something like that, yeah, rates will probably come down in the next year, but our what are prices going to do? I don't know. So anyway, the point is, just getting to the multifamily element of it, is the gap between renting and homeownership has never been wider. And so multifamily competes with single family. And right now, that that spread is making it very difficult for single family to compete. So more people are going to choose to rent than they would, or not even choose. They're not even going to be able to buy. You're going to have more people be renters by necessity for longer. A really interesting thing that he said also is, if the average person is a renter for, I think he said something like 15 years of their life. Like, so if the average rents for 15 years, but now because of these dynamics in the market, if they're now going to rent on average for 18 years, you just increase demand by a non-inconsequential amount. Like, that's a big increase in demand.
I don't think they're forecasting in as much to what inflation is doing to the average American who can't fix their costs, because rent costs are not fixed. They only go, typically speaking, in one direction unless supply absolutely decimates your market. And just back to this premise, which is all tied together, which actually is getting me so giddy about this discussion, and the inflection point of those leaving the rent space and apartment space into homes. I was actually at dinner last night with two gentlemen who started a mortgage brokerage company. Always great to be around entrepreneurs for many reasons. But I was with dinner with them, and they were like, listen, rates aren't going to go down as much as you think. They for sure will come down, but they legitimately, the Fed and whatnot, can't reduce that spread and rate on homes, because they would have too many homes and people that had just bought that would refi, which would destroy all the other notes that had just been written for the last couple of years. So that will delay the payment, or sorry, the decrease of interest rates over time. So you can't just plummet rates all of a sudden, because all those other notes would be absolutely obsolete. So that's not going to happen as quickly as they think it's going to happen. And they're basically saying, hey, yes, rates will get cut, but don't expect it to be back in the fours anytime soon. So I thought that was a good note and something to think about. And as homes and that becomes less obtainable, our world becomes that much more important to be in, to diversify and to invest into, assets like we are doing right now. So that's, very fascinating to kind of put these things and layer them all together.
I don't understand. I don't know the single family lending market at all. So I don't know if it's priced based on the 10-year or the 30-year or how that works.
I believe it's a Fed funds rate. And then they have to, so the Fed fund rate and then plus a spread, I believe is what it is. But they're
But
not
if
going to drop that spread as
but if you're
much.
borrowing
So,
fixed, why would you index off of the Fed funds rate?
I had to ask them once more, and we'll table this as well where it's based on, or maybe you could implement our good friend Google here. But they're not going to drop that what they spread it off of as much as we think they're going to is what their projection was.
Yeah, I mean, it's not my market, so I'm not going to be so confident when I say this, but as the young people say, I'm going to say that's cap.
Okay, I
That
don't know if it's a Fed funds rate, but they're not going to cut whatever it is to drop mortgages
Yeah,
lower. So
I completely disagree with that.
yeah.
Whoever said that, I just let them know that I disagree with every
So
ounce of
you
my
think
being.
mortgages are gonna plummet soon here coming up?
Well, yeah, I mean, I believe what Peter Linneman said, and I think plummet is 50 basis points. I think that the 10-year is going to come down by about 50 bips. So, yeah, I mean,
Yeah, I think we'll see a 50 point spread and drop. That's for sure, but not a whole 200 points or basis points. It would be my guess is what I was alluding to. But
yeah,
50 basis points is for sure reasonable. I mean, we're already seeing now mortgages sub 7%. So we've already seen that already. So that much is for sure. But it's not going to be to the point where it's dramatic, like we saw, cuts where rates were at where they were in 2020 and 2021 was
yeah.
the point that they were making, which is
Yeah, but
still
I also think this notion that, oh, they're not going to cut because they don't want the bonds that were previously issued, the mortgage-backed securities that were issued recently at a higher rate are going to be if anything, when rates go down, uh a mortgage-backed security or any bond that was issued at a higher coupon is now worth more. So it's going to make the previous loans worth more, not less. So I mean, whatever that person said doesn't make sense, but doesn't matter. The important part is that you and I agree 50 basis points is a reasonable drop to expect,
for sure.
which I mean, that's kind of what we're banking on in multifamily as well. I think it's going to be a bumpy ride. I think it's going to go up and go down, but all in all, the trend is down. And
I'd
again,
rather
also
be
the other reason why I take issue with that comment is my understanding or thought is, and I've got Fannie Mae mortgage-backed securities overview up. Single-family mortgage-backed securities begin with a mortgage loan. There are varying loans with a 15-year, 30-year fixed rate, adjustable rate. So I mean, if you're
go with
doing
a
a
30 year. The 30 year is a traditional note, a 30-year fixed.
right, so if you're doing a 30-year fix, which I'd imagine is most typical, I would think it's priced based off of the 10-year treasury or the 30-year treasury. So and I apologize for me not being educated on this, but I'm sure the people that are the single family experts in the audience will be able to let us know the specifics on this. But anyway, the point I want to make is the Fed does not control. The Fed has no control over the 10-year and the 30-year. That is priced by the bond market. Traders all around the world in Paris, Switzerland, and in Singapore, they buy and sell US treasury bonds every single day. And they are the ones that price those securities because if everyone's piling in and buying those bonds, it's going to drive the yield down. The Fed can't say, hey guys, don't buy those bonds, right? And nor can the Fed say, hey, don't sell those bonds. The Fed can,
Yeah.
however, through other means, manipulate the long end of the yield curve, right? Which is through actually buying and selling that treasury security directly. So if the Fed does want to see the 10-year go down, they can buy more of those bonds, which then drives the yield down.
Yeah. Well, I do think rates for mortgages will be higher than we all think for longer. That's actually is my
Yes.
forecasting, and rates will not get cut as much as people think they are on the mortgage side. That's my prediction and forecasting. But if as a homeowner, I'd be fine with it. I'll make more money. on appreciation, paper money, right? So we'll see. As I don't plan on ever selling this house, maybe I could pull out a HELOC, make some money there, and buy another house and tap into it, or invest in an incredible Lone Star Capital deal, of course. But yeah, and I also want to mention this here. You mentioned earlier replacement cost spreads, or so replacement costs, right? So my question to you is, when people, mention replacement cost, what is the spread difference when it comes to, and where does it need to be to actually make that relevant? If you're talking about a 70s, 80s, 90s, and 00s deal for that to be a relevant discussion, does it have to be 2000s or newer to really even be in consideration and such? So I'd be very curious to know how that's handicapped into the equation, of course, because if you're talking about replacement costs for something in the 60s, 70s, a lot of markets that's considered junk, right? So I'd be very curious to know your perspective on that. I had that note there for a bit, but we obviously derailed a little bit.
Yeah, so it's funny. I laugh when someone tries to brag about a deal being below replacement cost and they're buying 80s or 70s
Yeah,
junk,
right.
right?
That's why
It's like,
it made me inquisitive to think about how you think about that and perceive it.
yeah, no, of course this is below replacement cost.
Really?
This is closer to obsolescence than
Wait, your stick construction is with 7, 8 foot ceilings is below replacement cost.
yeah,
Who would have thunk? That's
right.
crazy. With no
So
washer and dryer hookups and boilers and chillers and stab blocks. Yeah, crazy.
yeah, so I hope you're not describing our latest acquisition. So
No, not at all, as a matter of fact.
so the yeah, I think to your point, the older you get, the less relevant replacement cost becomes.
Yes.
Similarly, the older you get, the less relevant new supply issue, the new supply concern is, right? So when you're talking about competing in the brand new space, like deals that are core plus that are 5 years old and newer, then replacement cost is very, very important. And if you can buy below replacement cost, that's really great. Because imagine just a simple example. Obviously, the world's very complicated, but what if a developer could build you a really nice property and it cost them $50 million to build it, and then they sold it to you for 50 million. So they put in all this work, years of entitlement and getting ground up ready and going vertical and all this stuff. And then
And you don't get paid for it.
they made
Yeah.
no profit and they just gave it to you 50 million. That sounds like a good deal for you, right? So when it's a brand new deal, buying at replacement cost or even a bit above replacement cost can mean a great deal. So when you're right there at the bleeding edge, replacement cost could be a great deal and plus or minus, right? But then as you get into, let's say, 10 years old or 10 to 20 years old, well, now it's like, okay, well, now you probably need, I don't really know what the relationship is, but you certainly would need 20% below replacement cost, 30% below replacement cost. And then you get into 90s, so 30 years, heading into 30 years old, you probably want to see 30 to 40% below replacement cost. So I don't have a great rules of thumb for it, but that's the general relationship.
I guess it's all basis. And speaking of which, shout out to ourselves. We bought a deal that was the newest deal in our portfolio, and we have other new acquisitions on the way that are coming up that are also 2000s and newer. But shout out to our deal at Meritage, just south of the Med Center in Houston, inside the inner loop there. That was part of the 3 property portfolio, for which we have actually about $100 or a couple $100,000 of space. And if you want to invest in that deal, but nevertheless, on that opportunity, it was about 275 on replacement cost. We acquired that one at about 181 or 183 per unit, which is pretty special. So that is a very, very handsome and attractive buffer. Also coupled with the fact that there's approximately zero, and I mean zero, a big old goose egg on new supply coming to that area. So whoever said you can build anything anywhere in Houston, yes, you are right. But on this fact, there's no one doing so in that area. So there's a nice moat around the supply.
Yep, that's definitely a good point.
Absolutely. Well, any other items you want to speak on regarding the buying window? That was truly one of the longer segments in Capital Spotlight history.
I didn't even realize that was the segment. I thought that was just the whole shebang. So no, I don't think I want to add anything. I think the big thing that I may have conveyed is that I think the window is sooner and shorter. So previously
And
I
it's
thought that it would be happening later and that it would be a bigger window. Now I question uh those both of those things. I think it's happening sooner, like basically right now, I think is the time. And I think that's also evidenced by the fact there's not a lot on the market. And so whatever comes to the market, jumping all over and seeing if it makes sense, as we always do. But yeah, so I think it's happening sooner, which is now, and then it's happening for shorter. I think that the election is the curveball that is thrown into this because what's going to happen at the end of the year?
we don't even know who's going to run on both sides, frankly. So
And,
that's
and I
all.
don't even think
Yeah,
that really matters. It's just
yeah,
every election, it's the same thing. There's the lack of certainty, and uncertainty stifles transaction activity. That's just the
correct.
reality of it.
Right. And to kind of put a bow on that conversation on the buying window, NMHC is a deal making conference, and Brad, our incredible director of acquisitions, alluded to and mentioned the fact that it's actually going to be quieter this year from every broker, is what is their anticipation, which is kind of a bummer. And similarly, another canary in that coal mine, if you will, is also the fact that Brad had to actively reach out to several brokers when he was also there for the national championship, parlayed it into an incredible work trip to go to Houston and in Dallas. Sorry for his loss on the Huskies. If you're a Michigan fan, congratulations. But he said he had to actively reach out and proactively set up meetings with brokers and whatnot to get him tours. So that really goes to show that there's not a lot of distress because there's not a lot of activity. It takes two to make a market, as we know. And if sellers aren't selling, or if they're waiting, that's one thing. So that really is tied back to my theory that I truly think that if people can on their maturities, they have one this year, that they're just going to wait for the first rate cut where they feel they're going to be in a better position to capitalize better on their potential losses, if there are any, in regards to their deal that they're exiting in the market right now. On to the next topic here. So I think I sent you a meme or kind of a picture or something breaking down. It wasn't like funny, but it was just basically a little picture showing how diversification, how if or Warren Buffett advised Bill Gates to diversify, and due to that, he missed out on maybe $1 trillion or so. So the premise here is diversification is not how you make money. Or diversification is not how you make money. It's how you avoid losing it. So I also have a thought as well. Principle and Rich I poured at is to get really, really focused and niche into a couple places, and you can be riskier and spread out from there. And I truly believe this. I want to have the core of my net worth and base directly tied into our deals, as well as just generally real estate. So just real estate heavy for that bucket to create there, and then I can get more speculative if I want to get into crypto or stocks, bonds, you name it, whatever it could be, something outside of that premise there. But thought that was very interesting, and would love to have your take on it, because you've always said, "Lay, I want to keep it simple. I just want to invest in our deals," and I've kind of thought about your investing strategy a little bit different, which I can appreciate, and especially appreciate it after looking at that graphic as well.
Yeah, yeah, that was a funny thing you sent me where I think the number was when Bill Gates and Warren Buffett met. Bill Gates had 130 billion or something like that in Microsoft stock, and Warren convinced him to diversify because it would be safer. And it is true. I mean, diversification
Typically,
is safer for sure. But if Bill Gates would have just held on to his 130 billion of stock, it would have gone to like 1.7 trillion or something like that. So the and sometimes if it works out, the best defense is a great offense, right? So it's tough. But then at the same time, right? Microsoft, while very, very small chance, maybe it could have gone to zero, right? So what's what is more important? Your 130 going to 1.6 trillion or your 130 billion going to zero? I mean, obviously both of those are extremes and likely impossible, but you get the picture. The important comment there is once you have made whatever your number is, 5 million, 50 million, 100 million, a billion, once you've made that money, it's life changing to lose it, but it's not life changing to double it, right? Generally speaking, obviously there's inflection points and different things like that, right? You've got car money, watch money, plane money, yacht money, right? There's levels. So the point that we wanted to make on this show is the fact that if you're growing your wealth, you're not going to diversify your way to riches. That's just not usually the way it works. You have to be very angular, very focused. And for me, in my life right now and the stage that we're at, I think it makes way more sense for me to be plowing all my capital into our deals and into our business to just add more fuel to the fire on this rocket ship, right? Exactly.
And
So,
yeah,
so yeah, so and it's actually funny because a couple years ago, I got distracted and I started thinking, oh, well, I should invest in venture and I should have an allocation into the stock market.
I should have an egg here, an egg there, an egg everywhere, kind of wide, an inch wide, not a mile deep, right?
Yeah. And what happened there is, first of all, and I think we talked about this on last show or 2 weeks ago or something, which a lot of people, when they diversify, they're not actually diversifying, right? They're just getting a parallel exposure. They think they're getting diversification, but it's like, hey, if you buy a multifamily deal in Texas and then you buy S&P 500 ETF, they're not that different. They're both just heavily correlated to interest rates. I mean, obviously the tax implications are different,
Okay.
cash flow profile is different, but you're basically just going short on interest rates in both of those environments. So whether you're investing in VC's super heavily correlated to interest rates. Real estate's correlated to interest rates. The stock market's correlated to interest rates. Bonds are correlated to interest rates. So here you have all these different investment vehicles, but they're really just short rate vehicles. So if you actually want to diversify, you need to have short rate investments, which most of us do. Then you need to have also perhaps long rate investments. So going long on rates would be like, for example, owning floating rate debt, right? Not borrowing floating rate debt, but lending floating rate debt. Because if rates go up, your coupon goes up. So you can be long rates that way. You can be long rates by being short the market. I mean, that's not exactly perfect, but those are just some examples of actually being diversified, actually being hedged. But anyway, we're getting distracted. The point of the whole story is our you and I are both bought into this idea of, hey, let's go all in. Now's the time to be angular, to be focused, and diversifying in many cases is just diversifying. And yeah, I'm not for it. All my dabbling in VC and the stock market and stuff like that, don't enjoy it. It's a distraction. I want to have a simple life, simple uh personal financial statement. It's just all in Lone Star deals.
Simple for you, but not your accountant who will have to sort out hundreds
Many
of K1s at
K1s.
some point. Exactly, but that's their problem, not ours, of course. And with that said, as well, of course, your equity could go to zero in a deal, but real estate will never go to zero, especially where we acquire it. And I like the fact that we have more control. It's not realistic for Microsoft to go to zero, but the example was him diversifying at that point, which maybe at that point it's wealth preservation, not wealth creation. On my end, I truly believe that with the insights and the knowledge I've gathered from this real estate business and industry, I feel very confident that going very deep in real estate, I'll be able to, take very nice calculated risks where we have more control on it as opposed to picking a couple individual stocks that could theoretically the company could get bankrupt and you could lose your money there. Right. So I feel very comfortable and confident with my set of knowledge and eyes and our approach and touch to our deals and what we're looking to acquire there and in the markets that we're in to take care of that. Ultimately, real estate's the ultimate hedge on inflation and whatnot. So that's kind of the thoughts we had there. And don't outthink it. If you're looking to get in stocks and bonds, I recommend the S&P 500. My dad's been a financial advisor my entire life. I've never once heard him talk about an individual stock. So he knows a lot. So, but although we have our disagreements and philosophies with regards to investing, biggest argument we get into is me not putting more of my retirement money in my retirement account, which is a topic for another day, of course, but all interesting nonetheless. Another topic we wanted to get into, or I think you're passionate about this, and we kind of went back and forth on this. We had a very, very fun conversation, which is standalone deals or packs. We, of course, just did the 3-property portfolio. And I'm very curious to know, you, the listener, what your perspective on the matter is, if you prefer to have a pack of deals to get into, a bundle, diversification play, a spread, if you will, or if you want to invest in an individual deal. So we don't have a rolling fund here at Lone Star. It's an individual entity. You know exactly what you're getting into, the debt profile, when it closes, if there's not a 9-month delay due to some tax abatements, whatnot. But you know kind of roughly what the deal is going in cap rate, debt, so on and so forth. And obviously the pack, you'd have some of that information as well. But be very curious to know if you're more interested as the viewer and the audience, and potentially a client and partner of ours, if you're more partial to a multiple deals you would raise for or standalone. But we'd love to hear your thoughts, Rob, as to what you think is more optimal. What is your kind of, what prompted and sparked the idea, and kind of what you think we're going to do?
Yeah, I'm just thinking about how we can smooth and simplify the business and not drive ourselves crazy. And so the simple idea is, well, every time you have a deal, you have to put it under contract, you have to do due diligence. And this is true. I mean, you're never going to get away around these things. However, there are things that you could double up on or get some economies of scale, if you will. For example, if you are basically if you're raising money for the deal or for the portfolio, you can you don't have to necessarily make a pitch deck for every single deal, right? If you're doing a 3-property portfolio, you can do 1 pitch deck instead of 3. Okay, so now you have some savings on time there. Well, you can do 1 webinar instead of 3. There's some more savings. When you're talking to investors and getting investors to commit, you're getting them to commit to 1 deal instead of 3. So it's really, the savings is, as I mean, I haven't thought through this fully, and I kind of just wanted to talk this raw on the podcast just to let, I don't know, just to let it fly, and it's productive for us to brainstorm. But, and also, like you said, we'd love to solicit feedback from listeners as well, as far as what they think is smooth, what is attractive from the investor angle, and what kind of portfolios are attractive. If we are going to bundle deals together, should they be in disparate markets to provide diversification with one investment, or should they be clustered, right? If we're buying in Northwest San Antonio, should we buy 2 deals there and then package them together and there you go? Or what if we have a deal in Houston and in Dallas, and then we have a pack there, right? So,
Or yeah, well, and let's go on. What if we had a deal in San Antonio, Dallas, and Houston? Or what if we had a raise where it was 3 deals in Houston, a Houston 3-pack again, but it was a 2000s core plus deal, a 70s 80s deal that needs a big lift, and then like a mid 90s garden style nice asset where there's 3 prongs and 3 looks at that deal there. Is that more attractive, where you're kind of getting the full array of deals and kind of returns, and you're balancing out your risk metrics? Be very fascinated to know what the most optimal route is, if that's even attractive to people to fully get that, because sometimes there's payment for risk. Maybe there's a deal in that is a floating rate debt profile, and one that has a bridge, this that could get really complicated, but then you're kind of hedging, if you will. So I don't know. It's interesting to think about. Or if it's all gonna be, hey, 90s deal, a 90s in Dallas, San Antonio, and Houston. So just be curious to know what's interesting. I don't know if that maybe sparked an idea for you there, but how creative you could get in that. And obviously, we take what we can get. It's not like we can just say, well, I want to buy this, and there's a good opportunity coming up. We want to buy the best deal that we find in the marketplace at time, and that's probably best, because strategies need to change as the market cycle ebbs and flows and opportunities come up. But would be curious to know if that sparks any other ideas for you as we're flushing this idea out.
so I start my sentences a lot with so. Got to clean that up. So,
Yeah, well, I have things of that nature as well too. I have a lot of
filler
speaking
words.
quirks and filler words that need to get ironed out. So
Yeah.
back to you.
So, yeah. Well,
Yeah.
good thing we're not professional podcasters, right?
Yeah.
We just do this for fun. So, oh man, this is bad. This is bad.
So
So, here's the thing. If it is 2 deals that are the same market, same vintage, same strategy, same financing style, right? Fixed rate, 5-year debt, let's say, then I don't think anyone is going to take issue with the packaging of two deals that are the same. Because if they're comfortable with the exposure of deal A, and if deal B is very similar, then why wouldn't they be comfortable with exposure on deal B as well, right? So I don't think investors would really take any issue with a package of two or more deals where they're all the same, roughly speaking. So that's kind of just easy, no problem. But then when they're different, that's when the question pops up. And that's where you could definitely drop out, see some investors drop out because if we're only going to let them invest, I know now I'm a ghost. If we're only going to let them invest in the pack and not in deals individually, and we have a Dallas deal and a Houston deal, well, guess what? You know this. There are some people that just don't like Houston, but they like Dallas, and maybe that causes them to not invest in the portfolio. So, yeah, it's a challenging
Also,
topic.
yeah, and RN2, how does it look from a JV situation? If a JV group, a joint venture opportunity comes up from an institutional group that wants to take down said deal, well, how do we stack out the equity on one side or another? Is it going to be fully slivered in one side or another? Is it going to be top heavy somewhere? So it can obviously create complications, but also upside as well. And kind of sparked a thought to me talking about not really diversifying. If we do, three deals, Houston, Dallas, San Antonio, and they're all, market rate, all kind of around the same vintage, is it truly anything different, or are we all just getting market beta as, rising tide raises all ships, right?
Yeah, well, I think it's good, all else being equal, you're getting good diversification across the different markets, right? So you might get a little bit of different performance out of those deals for sure, being in different markets. So, yeah, I think there's some value there. But again, it might be offset on our end by the headache or the challenge of raising the capital for something like that rather than keeping them standalone. So yeah, the big $1 million question is the time savings associated with packaging deals together worth the extra headache of overcoming investors' challenges with investing in said package? That's the crux of the matter. And I think it's obviously dependent on the situation, like I talked about. If it's two deals that are exactly the same, then it makes 1,000,000% sense to package them together and work through any complications. And then, yeah, so I think, and the reason why I'm bringing this up, like I said from the very beginning, is because we want to improve our processes, make our lives easier, and scale. And so, if we can package deals together such that we can do them faster and easier, then that will help us finish the year with more transaction volume. So, that's the big question. So hopefully we can get some feedback from listeners and yeah, it's just a good like my dad always says, it's free to think. It only costs calories.
Right, right, right. And we like to burn those here. Well, with that said, let's move on to the final thing. This should only be very brief here as we've kept everyone hostage. If you've listened this far, thank you so much. For maybe an hour and 30 minutes would be my guess without a timer and the recorder on. Is that about right? Probably about right, I would guess. But books and resource lists. So Rob, why don't you explain that? And actually, I'm going to go out and hold you something and propose something to you. Maybe on LinkedIn once a month, you can talk about the book you read and the articles or content that you listen to, just to enrich people and put the best information out there, as you are truly at your heart a teacher. You obviously you're an educator, you're not a teacher, but as an educator, I think it'd be really cool if you actually did a monthly first of the month. What did you consume? If you track that, I think people would find that very valuable. And I think on this show, once a month, we'll talk about our consumption of what we did, not about what we ate. Maybe if you went to Fort Charles or Carbone, we'll allude and mention that. Maybe we'll take you out if you bring us a nice check, or if you want to work with us, we'll happily do so. But with that said, if you could go to the resources and books that you recommend, and then maybe we'll just do a monthly segment on LinkedIn, both posting what we're consuming, and then also keep everyone abreast on that listens to this to kind of create our community here. But with that said, if you would please go to the resource list, that would be incredible.
Yeah, so I would love to create somewhat of a book club community connected to this podcast. That would be super cool. And I would love to be pushed by the group to read more. Get more reading done would be great. So currently I'm reading, and it's been a while. It's way too long, but I'm currently reading Set the Table by Danny Meyer. That's a very big restaurateur here in New York. That's a separate conversation that I want to get into at some point, which is kind of a deep dive
Yes.
on restaurants and all this stuff going out, which has really grown as a much bigger passion for me. I'd say like it's up there. Restaurants, going out to eat, boxing, pickleball, working out, like those are
Friends, watches.
yeah, watches, pickleball.
We
Yeah,
keep it simple.
those are big. Those are big. Those are the big ones for me. So, uh, yeah, we'll talk about that later. But yeah, this is a good book. Set the table, but I certainly wouldn't recommend it to everybody because what are you going to spend 500 pages reading about some guy and restaurants? I mean, yeah, maybe there's good business insights and stuff, but this book is long. So anyway, as far as a resource list, I know that people were asking for a comprehensive resource list. You're gonna have to wait on that. I'm just gonna give you a couple musts for now, and then we can perhaps expound on these musts and maybe grow the list as well. So starting it off,
Also,
yeah, go ahead.
you gave me a training manual at Lone Star Capital prior to as my education to get into this. So I do have that Google sheet stashed away. It's stored. If you're looking for that and you want to know what Rob sent me to get me up to speed, going from someone who had no multifamily knowledge into someone who has kind of an idea where it started, I can get that over to you. Give me an email, craig@lsre.com. It's a lot of Rob's YouTube videos, but they're nutrient dense, they are jam packed, and these are items that I need to be rewatching to continue my education, to reharp on facts and information. So if you want that, please reach out to myself.
And let's make sure we review that list and scrub it of any company secrets. Can't give away everything.
Mm-hmm.
So yeah, let me
Well,
know. Share.
maybe if you email me right now and you're urgent, you might get the fully loaded, fully leaded version of it.
Yeah, yeah. Share that with me before people start
Right,
running off and making millions. So
right.
yeah, let me just give a couple here. Getting More by Professor Stuart Diamond, actually at our very first LSC summit, which I think was what, 2021. We had Professor Stuart Diamond come and give a half day boot camp on his negotiation tactics and stuff. So obviously negotiation is embedded in everything we do, whether you like it or not. Every interaction is a negotiation. Sales is a negotiation, and Getting More is a really fantastic book that has great advice on negotiation in a collaborative way rather than a combative I win, you lose way, which I like. 48 Laws of Power is the opposite of Getting More, right? 48 Laws of Power is classically a very manipulative book. It talks about, if you want to say, dark triad traits and
Machiavellian tendencies.
Machiavellian tendencies.
Machiavelli. As one of our
And
friends says, Machiavelli, Machiavelli.
yeah, well, yeah. So,
You know who? You know Hoots.
of course, of course. So, those are nice complements to each other because you get the dark side of negotiation and manipulation with 48 Laws of Power. You get the good side with Getting More. I think that's all good. I'll just I'll give one more, which is different from those, different category, which is The Power of Now by Eckhart Tolle. So that is a book about presence, which that is the ultimate gift in life is the present moment. There are no problems in the present. The only problems that exist in your life are in the future and in the past. But the present is perfect, which is a really profound, it's very simple, but it's extremely profound. And you sit there and read that book very nice and slowly. You probably read a whole page of it and go, wait, that didn't make any sense. Let me read it again. And then you read the page again. And then it just kind of beats these ideas into you. And it's just a really, it can be an enlightening experience to kind of understand that. And coupling that with meditation, which is exactly my experience that I went through when I discovered these topics and whatnot as far as meditation and presence, it was really transformative for me. So yeah, those are my recommendations for now, and let's keep them going.
Cool. Well, my recommendation, Rich Dad Poor Dad, and both of Rob's books. So I'll leave you with that there. Any other items, any other YouTubers or anything like that? Obviously, All In is a podcast we recommend. Uh, any other resources that you think could be useful? I know we need to probably refine this list, collaborate on this, and really have this buttoned up so we can provide extra value on top of the great nutrient dense shows that we provide to people. But any other resources that you can think of prior to the ending of this very long edition of the 30th episode of Capital Spotlight?
No, let's leave it at that.
Cool. Well, thank you so much for listening. We will see you next week. Everyone have a lovely weekend or week, I should say, because it's Friday for us. But yeah.